Apple reported quarterly financial results after the stock market closed on Thursday, October 31st. That was a bit of a mixed bag. It had some good and some bad inside of it. I'll review what was good and what was bad in this video here. I'll also update my buy recommendation for Apple stock. I've had Apple stock rated as a buy all year long in 2024, and it's performed surprisingly well, better than I would have thought it would perform this year given the headwinds it's experienced in the business. Apple's trading at $225 a share as of this recording. That's up from around $190 per share to start 2024. So let's review the latest financial figures from Apple.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/parkev for the 10 best stocks to buy now.
All right, so one of the bright spots coming out of Apple's latest quarter, which ended September 28th, 2024, is that total net sales increased by roughly 6% year over year to 94.9 billion. That was up from 89.5 billion in the same quarter last year. Interestingly, the services segment grew by more than $2 billion to 24.97 billion, up from 22.3 billion. But the cost of goods sold in the services segment stayed flat at 6.485 billion. So this demonstrates that economies in scale metric that I've been talking about and why the services business is an important part of Apple's business and one that is boosting its profit margin. Because when it adds a new customer to a services business, let's say to Apple Music, it doesn't cost the company very much money for that next subscriber, or if it adds a new subscriber to Apple TV Plus. It doesn't add that much cost to Apple's business. As you can see here, the cost didn't go up at all year over year. And so that creates better profit margins when you have growth in the services business. That being said, Apple can't completely rely on the services business because it needs to sell iPhones to then sell services. Without an iPhone, you're unlikely to subscribe to Apple Music. Without an iPhone, you're unlikely to generate advertising revenue through Alphabet's partnership with Apple. Without an iPhone, you're unlikely to buy an Apple Watch. And so the iPhone is so critical to the company's overall business, even though the services segment is growing very nicely. Overall, operating income jumped by more than 2.5 billion to 29.6 billion, up from 26.9 billion in the same quarter last year. However, net income fell because Apple had to pay more taxes for some of its business outside of the United States. Apple has historically paid a very low tax percentage overall because of the way it categorizes its business as it's around the world and it's international and different tax rates, and it tries to focus its profits in locations with lower tax rates, and so it optimizes its tax rate. That came to bite Apple in the latest quarter. $14.8 billion in taxes paid, up from $4 billion in the same quarter last year. So it had to pay an additional $10 billion in taxes due to some issues with its overseas tax rate in one of the countries it operates in. This is unfortunately an inevitability for these companies that are operating with these lower tax rates because of the way they organize the business. There are several companies like this. Nike is another one that pays a historically low tax rate compared to its revenue. The US income tax rate is much higher than the effective tax rate paid by Apple and Nike and some other companies that are international, and they can have the flexibility to shift some of their profits and costs across regions with lower tax rates to optimize taxes. Now, a couple of bright spots emerged in the latest quarter. Number one was the Greater China business, which was flat year over year in the latest quarter. That was a huge sigh of relief for Apple stock investors, including myself. I own Apple stock. I've owned Apple stock since like 2014 or something like that. I've got a huge capital gains embedded in my Apple investments, and so I'm unlikely to sell this investment even if I feel it's overvalued. Unless I feel it's grossly overvalued, I probably won't sell this stock because of the huge embedded capital gains tax in there, unless I have a loss to offset that. And in that case, I might sell it at some point. Now, the reason why this is a huge sigh of relief is because so far in the year, if you exclude the latest quarter, the business in Greater China was down. So it's down by roughly 6 billion in the 9 months so far in 2024. Sales of 66.95 billion in Greater China, down from 72.559 billion in the same time last year. Now, that's partly because of competition, and it's partly because the economy in China is performing less than great. I would say it's in difficulty. The government there is working on stimulus to try and boost the economy, but it's not performing well, and it's brought down by a property sector that's in trouble, a lot of debt in the government sector in China, and consumers are not spending as robustly. And then there's the added headwinds with all of these tariffs, and the onshoring of so much of the supply chain has really hurt the economy in China because it's so heavily export based that when exports in that country falls, it hurts the broader economy overall. Another bright spot was iPhone sales, which increased to 46.2 billion, up from 43.8 billion in the same quarter last year. Remember, there was only 1 or 2 weeks of the iPhone 16 sales embedded in this quarter that we just saw. The bulk of the iPhone sales will come in the next quarter, and already seeing this increase is great news for Apple stock investors. And next quarter, it could be even better, as Tim Cook highlighted in the release that the new iPhone sales are going well. The first few weeks have gone better than what happened with the iPhone 15, the previous generation, during the same launch period. And that was better than the iPhone 14 during the same launch period. So it's good news that iPhone sales are progressing better because, as I mentioned earlier, it's such a critical part of Apple's business overall. Cash flow from operations in the 12 months that ended September 28th jumped by roughly 8 billion to 118 billion dollars. Apple's business generated 118 billion dollars in cash flow from operations in the trailing 12 months. So this company makes 10 billion dollars in cash flow monthly, almost roughly 10 billion dollars monthly cash flow. That's incredible. That demonstrates just how lucrative Apple's business is. It's not just sales, but it generates strong profit margins on those sales and strong cash flow from operations on those sales, because Apple outsources a lot of its manufacturing as well. It runs on a quasi asset light business model here. It does invest with its suppliers, it helps them build up the capabilities to manufacture its products, but it's not relying on entirely itself for its manufacturing, and that allows the company to generate strong profit margins when sales are expanding and strong cash flow from operations, because it doesn't need to put those cash flows back into the business, continuously having to upgrade technology and increase manufacturing capacity. So Apple stock is now trading at a forward price to earnings of 27, which I wouldn't call this cheap. I also wouldn't call it expensive. I would just say Apple stock is fairly valued, but closer to slightly overvalued. That being said, Apple is an excellent business, very strong profit margins, great cash flows from operations, huge competitive advantages with built up switching costs that make it very inconvenient for anyone that's been with Apple for several years to switch to a competitor, even if they feel the competitor is better with lower prices. You're hesitant to switch because it would be such a time consuming thing to switch your phone service from Apple to, let's say, Samsung or anything else. It would take so much time to do that, and it would be an inconvenience. And so that embedded cost of switching is one of the competitive advantages Apple has built up over the decades with its strong ecosystem of products, services, and devices. So, with that being said, I updated my recommendation of Apple stock today on October 31st and reiterated that I think the stock is a buy. You'll do well in your investing lifetime if you buy excellent companies at fair valuations. Right? You'll do well. You might not double your money overnight with that strategy, but you'll do well over a 20, 30, 40-year period. Your wealth is very likely to increase if you do that. So that's one of the reasons why I still have Apple stock rated as a buy, even though I don't think the stock is undervalued. I just think at even a fair value, you're going to earn a reasonable rate of return on your investment given the risk that you're taking with Apple stock. Thank you for watching this video. I truly appreciate it. I know there's a lot you could be doing with your time and a lot of other videos you could be watching. So I truly appreciate that you chose to watch this one. If you want to see more videos just like this, hit the subscribe or the like button. They'll both help me make more videos just like this one. Thank you again.